Warren Buffett's Advice, a practical guide to investing, business, and life. Warren Buffett, often called the Oracle of Omaha, is not famous because he predicts markets. He is famous because he doesn't. His success comes from clarity, patience, discipline, and a deep respect for long-term thinking. Buffett's advice is deceptively simple, yet extremely hard to follow in a world driven by fear, greed, and noise. This guide organizes Buffett's core wisdom into practical ideas you can actually use. 1. Invest like a business owner, not a trader. Buffett's most important mindset shift is this: when you buy a stock, you are buying part of a business. Most investors think of stocks as moving prices on a screen. Buffett thinks of them as ownership stakes. He asks, "Do I understand this business? Will it still be strong in 10 or 20 years? Does it generate consistent cash? Does it have a competitive advantage?" If the stock market closed tomorrow for 5 years, Buffett wants to be happy owning the business anyway. This mindset filters out speculation and focuses attention on quality. Advice to apply: read company annual reports, not price charts. Ignore short-term volatility. Ask whether you'd be comfortable owning the business privately. 2. Stay within your circle of competence. Buffett repeatedly says, "You don't need to know everything. You just need to know what you know and what you don't." Your circle of competence is the set of businesses and industries you truly understand. Buffett avoided tech stocks for decades, not because they were bad, but because he didn't understand them well enough at the time. This humility protected him from catastrophic mistakes. Key insight: it's not how big your circle is that matters, it's knowing its boundaries. Advice to apply: invest only in industries you can explain simply. If you can't explain how a company makes money, don't invest. Avoid trends just because everyone else is making money. 3. Buy wonderful businesses at fair prices. Buffett's early mentor, Benjamin Graham, focused on buying cheap stocks. Buffett evolved that idea. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. A wonderful business has strong brand power, loyal customers, high returns on capital, pricing power, durable competitive advantages, a moat. Examples include companies like Coca-Cola, Apple, and See's Candies, businesses that remain relevant for decades. Advice to apply: focus on business quality first, valuation second. Avoid companies that rely on constant reinvention just to survive. Long-term consistency beats short-term bargains. 4. Think long-term, very long-term. Buffett's favorite holding period is forever. Time is the greatest ally of a good business and the greatest enemy of a bad one. Compounding works miracles only when you allow it enough time. Many investors fail not because they're wrong, but because they're impatient. Advice to apply: measure success in decades, not months. Let compounding do the heavy lifting. Avoid frequent buying and selling. 5. Ignore market noise. Buffett treats the market as a servant, not a guide. He famously described the market as a manic partner who shows up every day offering to buy or sell at emotional prices. You don't have to listen. The market exists to serve you, not instruct you. Advice to apply: don't watch financial news obsessively. Price movements are not the same as business performance. Use market fear as opportunity, not instruction. 6. Be fearful when others are greedy, and greedy when others are fearful. This advice is simple, but emotionally brutal. Most people buy when prices are high, confidence and hype, and sell when prices are low, fear and panic. Buffett does the opposite. He doesn't predict crashes, he prepares for them. Advice to apply: build cash reserves for downturns. Buy quality businesses when others are panicking. Don't chase bubbles. 7. Avoid debt and leverage. Buffett is cautious about debt, both personally and in businesses. Debt reduces flexibility and increases fragility. Even great businesses can fail if debt is mismanaged. Buffett prefers companies that generate their own cash, can survive recessions, don't rely heavily on borrowed money. Advice to apply: avoid investing with borrowed money. Favor companies with strong balance sheets. Personal financial stability comes before investment returns. 8. Management quality matters more than you think. Buffett places enormous importance on leadership. He looks for managers who are honest, rational capital allocators, shareholder-focused, long-term thinking. He often says he'd rather invest in a great business with average management than a bad business with great management, but great management still matters. Advice to apply: study how executives allocate capital.
Watch for integrity, not charisma. Beware of leaders obsessed with stock price instead of business fundamentals. 9. Simplicity is a competitive advantage. Buffett's strategies are not complex, they are disciplined. Complexity often hides risk. Simplicity allows clarity and consistency. Advice to apply. Avoid complicated financial products. Stick to strategies you can repeat for decades. If you need a spreadsheet to justify an investment, be cautious. 10. Learn continuously, but selectively. Buffett reads for hours every day, but he doesn't read everything. He focuses on business fundamentals, history, human behavior, mistakes, especially his own. Advice to apply. Read annual reports and shareholder letters. Study past market crashes. Learn from failure more than success. 11. Temperament beats intelligence. Buffett often says investing success is more about temperament than IQ. Emotional discipline, staying calm during chaos, is the real edge. Advice to apply. Build rules and stick to them. Reduce emotional decision-making. Know yourself and your emotional limits. 12. Index funds for most people. Despite his own stock-picking success, Buffett strongly recommends low-cost index funds for most investors. Why? They outperform most professionals over time. They remove emotional mistakes. They require no prediction skill. Advice to apply. If you don't want to analyze businesses deeply, use index funds. Keep fees low. Stay invested consistently. 13. Reputation is everything. Buffett's advice on life is as strong as his advice on money. It takes 20 years to build a reputation and 5 minutes to ruin it. Integrity compounds like money, but faster. Advice to apply. Choose honesty over profit. Protect trust at all costs. Long-term success depends on character. 14. Define success beyond money. Buffett measures success not by net worth, but by who loves you, who you love, whether people trust you. Money amplifies who you already are. It doesn't fix character. Advice to apply. Invest in relationships. Choose work you enjoy. Don't sacrifice values for returns. 15. The biggest mistakes are psychological, not analytical. Most investors fail because of overconfidence, impatience, fear, greed, social pressure. Buffett avoids these by staying independent, thinking long-term, accepting boredom. Advice to apply. Don't compare yourself with others. Avoid FOMO, fear of missing out. Boring investments often win. Final lesson. Patience is power. Warren Buffett's greatest advantage is not intelligence, information, or luck. It is time combined with discipline. His advice can be summarized simply. Buy good businesses. Understand what you own. Be patient. Stay rational. Protect your integrity. These principles work not only in investing, but in life.